Ladies and gentlemen, my name is David Halsey. I'm author of Trading the Measured Move and eminiaddict.com. This webinar is on hedging strategies, but it is not investment advice. Commodity futures trading, futures and options trading has large potential rewards, but also large potential risk. I'd like to start off here with a little bit of a story, and it's about a gentleman that happened to sit next to me at a financial conference that I went to, and it's now been over 20 years ago. As we waited for one speaker to leave the stage and another one to arrive, he sat down and he started chatting with me. And I asked him what his trading strategy was. And he said that he was a collector. I thought that was funny. I asked him what he collected. He said, I collect shares of companies, ounces of precious metals, and assets. And he said, I use futures contracts to protect my positions. And instead of suffering from drawdowns, I capitalize on them. And I use them as opportunities to lower my cost basis, increase my position sizes, and offset risks in the market. At the time, I didn't fully understand what he meant, but very soon after, I began to value the wisdom that he had shared with me that day. And I do think about him every day. His words are still ringing in my head. And I often think it's very valuable to think while you're trading, from the perspective of the collector. This is a classic hedge fund strategy. These strategies are what futures contracts were literally designed for. They are nothing new, but he executed them as his own hedge fund manager, speculator, and investor. I never saw that gentleman again, but his words of wisdom are still with me. And that's what I want to share with you today. First of all, we need to clarify what the definition of hedging is. Hedging is a risk management strategy using financial instruments to offset potential losses from adverse price movements in an asset. In futures markets, hedging involves taking a position in a futures contract opposite to an existing or anticipated position in the physical market. The key principle is that when you lock in prices today for future transactions to create certainty in uncertain markets. The fundamental purpose of hedging isn't to make money. It is to create certainty in uncertain market environments. So think about your business. What price risks keep you up at night? Those are precisely what hedging aims to address. Risk management versus speculation. Hedging aims to minimize risk, not maximize profit. Contrast that with speculation. Speculators accept risk for potential profit. Think of a risk-reward ratio. Hedgers transfer risk to protect existing business operations or positions. The zero-sum nature of futures markets are this. For every hedger reducing risk, someone else, often a speculator, is taking that risk. This is what we're going to cover today. The historical context of hedging practices, technical mechanics of futures markets, practical applications across industries, implementation considerations and best practices, and then ultimately case studies demonstrating real-world applications. Where do the futures markets come from? The birth of the modern futures markets really come from the Chicago Board of Trade in 1848. It was founded to standardize grain trading. Two arrived contracts evolved into futures contracts. The Chicago Board of Trade led to the standardization of grades of quantities and delivery terms. They introduced margin requirements, and mostly after a crisis would happen, they did more and more regulation. The development of clearing house systems also developed in this time here from the 1880s until the 1920s. There was also the elimination of counterparty risk through central clearinghouses. And then your daily mark-to-market process was established. Think of the clearinghouse as the central nervous system of a futures market. It touches every single transaction and provides essential stability. Then we have the financial futures revolution, and it came after the Bretton Woods collapse in the early 1970s. Futures contracts were needed for currency hedging. The Chicago Mercantile Exchange introduced currency futures in 1972. In 1975, they introduced interest rate futures. In 1982, single stock futures began trading. And then options on futures contracts started in 1980. Regulatory revolution. The Grain Futures Act of 1922 followed manipulations and the attempts for cornering of markets. The Commodity Exchange Act of 1936 extended regulation. The creation of the CFTC in 1974 created comprehensive federal oversight. And then there was a long pause until the Dodd-Frank reforms of 2010 in response to the 2008 financial crisis. International coordination, a derivatives regulation began. And what you'll notice is that how many of those regulatory developments always came following a market crisis. The pattern continues today. More regulation after a crisis. Then there's the modern electronic era. The transition from open outcry, the pits, to electronic trading came in the late 1990s and early 2000s. Then there was the globalization of futures markets, 24-hour trading. Then came all of our algorithmic and high-frequency trading. Really, essentially, making markets, making the market-making aspect of markets left to computers. Real-time risk management capabilities began to come online, and then was, of course, the expansion accessibility for hedgers of all sizes and in all markets. The futures contracts defined are they're legally binding agreements to buy or sell a standardized quantity and quality of an asset at a predetermined price at a specific time in the future. The distinction from forward contracts is standardization, exchange traded, and margined, mark-to-market, and they're mark-to-market daily. They also have a zero-sum nature. For every long position, there must be a short. Basing hedging principles. The price risk exposure. Types of price risk include input costs, output prices, and asset values. We'll mostly think about them from the perspective of asset values. We have to identify exposure, the volume, the time horizon, price correlation. We're, in terms of assets, most concerned about price correlation. Quantifying risk exposure, the value at risk, scenario analysis, which we do in terms of measured moves. Natural offsets versus requiring hedging solutions. Then there's long versus short hedges. Short hedges, selling futures contracts, protect against falling prices. And who would those be? Producers, inventory holders. In our case, more than likely assets or metals or Bitcoin asset prices. An example traditionally would be a farmer selling corn futures to lock in a harvest price. A long hedge might be buying futures to protect against rising prices, processor manufacturers. Or another example would be a food company buying wheat futures to secure input costs. Then there's the perfect versus cross hedge. Now, a perfect hedge, and of course, it's important to remember that no hedge is perfect. It's almost impossible to make a perfect hedge. Futures contracts match, but what we mean by a perfect hedge is that futures contracts match a physical exposure exactly. So think about the SPY ETF versus the ES futures contract, or the NASDAQ futures contract and the Qs, or diamonds, DIA, the Dow ETF versus the YM futures contracts. Those are as close as you can get to a perfect hedge. Then there's cross hedges, using available futures when a perfect match doesn't exist. And we'll talk a little bit about that and how you can get an idea of what the relationship is with some trading platforms. We study correlations analysis for cross hedging, and then basis risk considerations for cross hedges. Examples of common cross hedges are jet fuel hedged with heating oil futures. The single most important concept to grasp is basis. The relationship between your physical market and the futures price determines hedging success or failure. Notice that perfect hedges don't exist in the world. The question is always about optimizing the trade between risk reduction and cost. Industry-specific applications, agricultural applications are producer strategies, pre-harvest and post-harvest hedging, securing input costs, seasonal patterns and considerations, combining futures and agricultural options, government programs, and their interaction with hedges. Then there's energy hedging, crude oil and refined products hedging, natural gas price risk management, electricity markets, renewable energy hedging strategies, and then carbon emissions and environmental markets, which is a thing now as well too. Then there's the mining industry, which we're more familiar with, precious metals and industrial metals strategies, mining company risk profiles, mining companies hedge with silver, end user strategies for manufacturing, byproduct hedging considerations, exchange versus OTC market usage. And then what we are more familiar with is financial risk institutions, interest rates, asset liability management, loan portfolio hedging, treasury management strategies, yield curve risk management, equity portfolio hedging, which we're mostly going to be talking about, index futures for beta reduction, sector-specific hedge strategies, pairs trading with futures, and portfolio insurance strategies. And then there's currency risk mitigation, transaction exposure hedging, translation exposure management, economic exposure considerations, multi-currency portfolio hedging. For investment portfolios, it's important to note that how the cost of hedging must be weighed against the potential for underperformance in rising markets. And this is true in any hedge. Are you getting in the way of a market creating a yield or a gain for you? And that's where it's important to know where to take hedges off as well too, which we'll get into in more detail. This is just a little bit of information about market structure. Most people think of contango and backwardation in relation to oil markets, but contango is when futures are priced higher than the spot. Backwardation is when futures are priced lower than spot. Advantages to hedging with futures. There are some distinct advantages for using futures instead of options. Options have all of the Greeks. They can degrade over time. They can be difficult to implement in some cases because there are so many things changing in the underlying Greeks that it makes futures much easier to execute. There's also the capital efficiency, requiring only margin deposits, typically 5 to 10% of contract values. This frees up capital to continue a dollar cost averaging schedule. There's tax efficiency. Futures contracts receive in a 60-40 tax treatment, 60% long-term and 40% long-term capital gains, regardless of the holding period. and it can improve after-tax returns on your hedging activities. There's after-hours protection. Unlike options, many futures markets trade nearly 24 hours, and they provide protection against overnight or weekend events. There's contract size flexibility. There's the standard, the E-mini, and now micro futures contracts, and they offer different exposure sizes that allow for more precise hedge ratios as your position grows. And then there's the correlation management, and you can use sector-specific futures, technology, financials, etc. to hedge specific exposures to help tailor protection to your underlying holdings. So a case study would be for a portfolio manager, and a portfolio manager that was specifically thinking about a market decline. The first thing that portfolio manager would think about would be what the index selection and the correlation analysis between the underlying assets that he was trying to protect and the futures market. Then how he would size them, and then timing decisions as well too, having a process for understanding when a hedge was needed versus when it wasn't. There's contract sizing, there's partial and then complete portfolio protection. Does that portfolio manager want to protect it, 60%, 70%, 110%? And then would be the cost considerations and drag analysis. You always have to think about how the performance of a trend will degrade or be amplified over time with and without hedges. What are the common pitfalls and limitations of hedging? First of all, mostly they're hedging imbalances. And so there are over-hedging risks. Not having a calculator is probably the biggest risk. Because you could easily be, if you're not paying attention, over-hedged. Or you could be under-hedged. And you could still have a residual exposure that you didn't necessarily understand or take into account. So mismatches in hedging. We're going to get into the psychological benefits of hedging. And this subject is vast. And you will find it is a never-ending, it is a rabbit hole to go down as far as the psychological benefits of hedging. Hedging provides several important psychological benefits that significantly improve your investing experience and decision making. So first, they reduce anxiety and emotional stress. When you have an appropriate hedge in place, market volatility becomes less emotionally taxing. You can sleep better at night knowing you have a protection against severe drawdowns, and that reduces the constant worry that's often accompanied by unhedged positions. It also prevents panic selling. In these incredibly volatile markets, you can imagine how big of a benefit this is. One of the most valuable psychological benefits on how hedging helps prevent costly emotional decisions. Say a market is in a sharp decline. An unhedged investor would often panic sell at the worst possible time. But with hedges in place, you're less likely to abandon your investment strategy during market turbulence. Hedges give confidence to maintain and build positions. Hedging creates a mental security needed to stay invested during market corrections, to continue dollar cost averaging during downturns, to add to positions when others are fearful. This confidence often leads to better long-term results as you can execute your investment plan with discipline rather than reacting emotionally. There's clearer decision making. When protection is in place, you can evaluate market movements more objectively. Your judgment becomes less clouded by fear or greed because the immediate threat to your portfolio is reduced or eliminated. This clarity often leads to more rational adjustments to a position. It enhances your planning psychology. Knowing that you have the ability for downside protection encourages more thoughtful position building over time. Instead of worrying primarily about timing the market absolutely perfectly, you can implement a more methodological approach to reaching your target allocation. That is probably one of the most important. And so we're going to go through just kind of a couple what if scenarios, and then we're going to start diving down into actual examples. So there are two investors. And the example is in March of 2020, the COVID market crash. So first is the unhedged investor. Her name's Sarah. Sarah had a $500,000 portfolio invested primarily in the S&P 500. When markets plunged 34% in March of 2020, her portfolio dropped to approximately $330,000. Despite her long-term investment horizon, the rapid decline triggered intense anxiety. She checked her account multiple times a day, struggling to sleep, and ultimately sold $200,000 of her holdings on March 23rd, precisely at the market bottom. This locked in her losses and left her largely on the sidelines during the subsequent recovery. The hedged investor, this is Michael on the right-hand side, he had a similarly sized portfolio but maintained a 15% hedge through the S&P futures contract. When the crash occurred, his portfolio declined to approximately $380,000 instead of $330,000. The $50,000 in hedge protection provided a critical psychological comfort. He not only remained fully invested, but he actually added to positions in late March by adding that capital that he had built from that futures gain. By July 2020, his portfolio had recovered completely and was in positive territory, while Sarah remained partially in cash, hesitant to re-enter the market. Here's some more examples here. Here's the unhedged investor. This is Robert on the left-hand side. He accumulated $300,000 in technology stocks over 5 years. When the tech sector dropped 30% in early 2022, his portfolio suffered. Despite believing in his companies long term, the daily volatility became unbearable. He constantly recalculated his losses and agonized over whether to sell. His stress affected his work performance and his family relationships. He eventually sold half his positions after significant declines, driven by emotional exhaustion rather than rational analysis. On the right is Jennifer. She is the hedged investor. She also held technology stocks, but hedged with NQ futures contracts, covering about 40% of covering 80%, of her exposure. Her portfolio declined significantly less. The hedge gave her psychological resilience to maintain perspective. She used the correction as an opportunity to add to her positions at reduced prices. Incredibly different situation. The hedges provided both financial and emotional protection, enabling her to execute her strategy with discipline. Here's another example of hedging psychological benefits through the rate hike cycle of 2022 to 2023. The unhedged investor, this is Mark on the left-hand side here. Mark had a bond-heavy portfolio when the Fed began aggressively raising interest rates. As bond prices fell, he found himself checking his account 15 to 20 times a day. Each new rate announcement triggered anxiety. Despite having clear financial goals, he began making reactive decisions, shuffling between different fixed income investments and attempting time-to-time interest rate movements. This frequent trading increased his costs and actually worsened his returns. And then on the right, we have the hedged investor. Karen hedged with a 70% position in Treasury futures contracts. Futures positions gained value, offsetting losses. She maintained her bond allocation, and avoided reactionary trading and increased her hedge. How do we use the hedging calculator? There are 4 steps to using the hedging calculator on the site. First is to identify what futures contract best matches the position. 2, type in the futures contract price for an accurate calculation. 3, enter the amount of the position in dollars to be hedged. And then 4, enter the dollar beta weighting. And we'll get into that a little bit more. But we're actually going to go to the site here, and I'm going to zoom in on this, the calculator. We're going to run through a couple of scenarios here to kind of get an idea of, how does this work? How would you do it? Let's explore a couple of case studies here. So imagine right now we're going to go back to 2022 here, and we're going to look at the daily charts, and we're just going to kind of put ourselves into perspective. Here's 2022 here. Let's create a scenario here. Alex, an experienced investor, has been steadily building a $600,000 position in the SPY ETF throughout 2021. So this huge uptrend that we were inside of. Concerned about growing market risks in early 2022, inflation concerns, geopolitical tensions, and the Fed tightening, Alex decided to implement a futures trading or a hedging strategy rather than selling positions. So in late 2021, we had these traditional longs that were setting up here, and then we broke trend. In January of 2022, Alex sold 3 E-mini S&P 500s. So his S&P 500, his SPY ETF, or where he was participating inside of the market here, was right around 4,700. And so he was trying to hedge right around that 4,700, the failed breakout at highs here, the trend change. And so we're going to bring in the actual hedging calculator, and let's bring that back here kind of as a visual. So we have the S&P 500. We're thinking about this from the perspective of, what was the price then? Well, the S&P 500 at that time was 47. When you enter these numbers, you hit tab, and then it brings up the correct price multiplier. This is a drop down for all of the futures contracts. So you have the correct price multiplier. What is he trying to hedge? He's trying to hedge a $600,000 position. So it tells him that he would need 2.81 futures contracts to hedge. Now, what is this dollar beta? It's 1.10. Now, this would hedge the portfolio or hedge the position by about 80%. Why 80%? Because, we're just estimating kind of 30% in taxes. What if you were to factor in, taxes? It would be, 1.33, I guess, right? 33% taxes, 3.4. Do you see how there's never a perfect hedge? There's never ever a perfect hedge. Ever. It's never perfect. But it's better than nothing. So if we were using the 1.10, and this is just how it comes, it's kind of pre-selected in there, but you can put anything you want in the yellow tabs. This hedge of 3 contracts covered about 70% of his market exposure. How far did we fall in 2022? By mid-June 2022, we had dropped to 3,700 points. We lost 14%. That's 1,400%. 14%. It's $92,000. Alex's physical portfolio declined from that 600,000 to, under 400,000, 450,000. But his short position gained $92,000 in value. His net portfolio decline was obviously much lower than if he had been, he didn't lose $92,000 because he was hedged. In mid 2022, Alex made a pivotal decision. When the S&P 500 was down significant, he believed certain sectors offered value. Rather than maintain his hedge indefinitely, he closed 2 of his 3 futures contracts, really realizing about $63,000 in profits. He kept 1 contract as a continued partial protection. Using that $63,000 in hedge profits, he significantly added to his highest conviction positions at discounted prices. He lowered his cost basis. In this decline, when we were going into the rate tightening process. So what were the psychological dynamics? The futures hedge provided crucial psychological buffers or benefits. Throughout the decline, Alex felt in control rather than at the mercy of market forces. The hedge's performance gave him the confidence to be opportunistic rather than fearful. By realizing actual profits from the hedge, not just paper gains, he had tangible capital to redeploy. The remaining partial hedge allowed him to add exposure while still maintaining some of his downside protection. And so what was the outcome? When the markets began recovering in late 2022 and beginning of 2023, Alex's portfolio included additional shares purchased at lower prices. He maintained a smaller hedge still that continued to provide psychological comfort. As markets recovered, his enhanced position captured more upside than if he had remained fully hedged or had panic sold during the decline. He eventually closed his remaining futures contract in early 2023 as his confidence in the market direction improved. The strategic use of futures contracts exemplifies how hedging can be both a risk management tool and a position building opportunity. The psychological security provided by the hedge enabled Alex to react rationally during the market stress, using hedge profits to accumulate additional shares at lower prices. And when the trends finally broke, and this is back in 2022, what was he doing? He was taking off his hedges, breaking out of shorts, and then buying pullbacks. The break of the short is where the hedges come off, and the pullback is where those gains are deployed. Let's try a different example here. So let's think about the S&P 500 during the COVID crash. This is February of 2020 here. Emma, a self-directed investor, had built a substantial portfolio of $850,000, primarily invested in the S&P 500 index or S&P 500 ETF in early 2020. In January of 2020, she began following news about the coronavirus outbreak in China with growing concern. So in February of 2020, when the S&P 500 was around 3380, and let's plug this into a futures calculator here. The price was around 3380. Emma decided to implement a partial hedge rather than selling her core long-term positions. Her exposure was $850,000. How many contracts did she need? says 5.5 here. In early February 2020, with the S&P 500 around 3380, Emma decided to implement a partial hedge strategy rather than selling her long-term positions. She sold 5 E-mini S&P 500 futures contracts. This created a hedge covering, as you can see here, almost 100% of her portfolio's market exposure. The reduced margin was much better than her selling, all of her gains, panic selling into that crisis. So then came the market crash in hedge performance. As the COVID-19 fears escalated globally between February 19th and March 23rd, the S&P plummeted 34% during that time. 34%. That is a loss of $317,000. But that's what her hedge made. Emma's portfolio dropped from $850,000 to right around $550,000. A paper loss of over $300,000. However, her short futures positions gained that $300,000 in value. Her net portfolio decline was very minimal. As markets reached peak panic in March 2020, Emma recognized the extreme fear in the market was a potential buying opportunity. On March 23rd, 2020, she closed 3 of her 5 contracts, realizing about $170,000, $180,000 in profits. She kept 2 contracts as continued partial protection. Utilizing that $170,000 in hedge profits, she purchased additional S&P 500 ETF shares, dramatically reducing her cost basis in the trade. The psychological edge during that crisis provided critical psychological advantages during unprecedented volatility. While friends and colleagues panicked as their portfolios crashed, Emma maintained remarkable calm. The substantial profits from her hedged positions counterbalanced the emotional impact of paper losses. Having a predefined risk management strategy in place allowed her to think clearly when others couldn't. The hedge transformed what could have been a traumatic financial event into a strategic opportunity. In late 2020, the VIX and the indices were going up for about 10 days straight up in a row. And we had these extensions that we were inside of. And they didn't quite reach their targets. But there were there were traditionals here that we went into a weekend with. And when those failed, and this is actually intraday. This was a Thursday, Friday, Monday. There were fail breakouts up here. There were entries to gap fills in the days leading up to that crash. The VIX was inside of long setups at this time as well too. So there were entries into the hedge. By August of 2020, the S&P 500 had recovered most of its losses, trading above 3,300 again. Emma's enhanced position, more shares purchased at the bottom, captured a significant upside of the recovery. Her willingness to partially close the hedge and deploy capital at lower prices substantially improved her long-term returns. She eventually closed her remaining futures contracts in July of 2020 as the market recovery became more convincing. This example illustrates how futures hedging can provide both financial and psychological protection during extreme market events. Emma's strategic use of futures contracts allowed her to remain invested for the long term while actively managing short-term risk. Rather than being forced into permanent losses through panic selling, she used the hedge to create buying power precisely when the market fear was at its maximum. This approach enabled her to outperform both fully hedged investors who missed some recovery and unhedged investors who often sold at the bottom. Let's look at a third example, and this is Bitcoin. We'll take a look at BTC here. Let's go to a Bitcoin chart here. Let's look at the spot market. See if we can find the beginning of the futures or the ETF here. This is back in January of 24 here. This is Jason. Jason is a retail investor with a growing interest in digital assets. He had been carefully building a position in the iShares Bitcoin ETF, IBIT, since its launch in January of 2024. By early February of 2025, just a couple months ago, he had accumulated 1,200 shares at an average price of $35 a share, representing a $42,000 position as Bitcoin approached all-time highs. So let's plug that into a hedging calculator here. First of all, we're starting off with 42,000 is more than likely going to be with MBT. And so we need to plug in the price of Bitcoin. In February, it was right around 100,000. Failing to break out of its previous highs after running into 110,000. You can see that's a tenth of the normal Bitcoin price. His value to be hedged was 42,000. He needed 4.62 contracts to hedge that amount. Jason became concerned about short-term volatility following the upcoming Bitcoin crypto winter. He decided to use CME Micro Bitcoin Futures, MBT, which represent a tenth of a Bitcoin each. He sold 4 Micro Bitcoin Futures contracts, creating a hedge covering approximately 90% of his IBIT exposure. Let's go take a little bit closer look at the price up there. And when we were back up at these previous highs, there was a series of long setups that we were absolutely in, but we were failing to break out of previous highs. We were failing to break out of previous highs. There was a moment here where we broke through the long setups. This is just, on price. Where would the hedge have taken place? After the break-in trend right here, going from 110 all the way down to 91,000, losing 20%, Jason hedged right around the 100,000 mark, right here. He sold those 4 Bitcoin futures, those 4 micro futures. So that's kind of how it would look in terms of a measured move. By the way, we're in another one of those right now, but let's get back to Jason here. He sold 4 micro Bitcoin futures, creating a hedge covering approximately 90% of his IBIT exposure. Following the decline in April of 2025, Bitcoin underwent a sell the news event, dropping by 30% to 80,000 by mid-April. Jason's IBIT position declined from 42,000 to 37,000, a paper loss of $5,000. A paper loss of $5,000. Let's put that correctly in there here. Minus 30. As Bitcoin stabilized around 75,000, Jason believed the worst of the correction might be over. He closed 3 micro contracts, 3 out of the 4. He maintained one contract as a continued partial hedge. Using the money of the hedged profits, he purchased an additional 55 IBIT shares at approximately $45 a share. The psychological advantage of that for the retail trader, the micro futures hedge provided benefits tailored to Jason's position size. As a retail trader, Jason couldn't afford the stress of watching his significant Bitcoin position fluctuate wildly. The micro futures contracts were a perfect size for his portfolio, allowing precise hedging. The hedge transformed his emotional response from fear to strategic opportunity seeking. Without needing to time the market absolutely perfectly, he had the confidence to add to his position during the correction. The remaining small hedge allowed him to sleep at night while still maintaining upside exposure. So what was the outcome? As Bitcoin began recovering in late April, which we're in now, Bitcoin has rebounded to 94,000. Jason's enhanced position captured more of the recovery. He eventually closed his remaining micro futures contracts as his confidence in the uptrend increased. The experience taught him how to use appropriately sized futures contracts as a tactical tool within his investment strategy. This example demonstrates how even retail traders with smaller positions can utilize micro futures contracts to implement sophisticated hedging strategies. The psychological comfort provided by the hedge enabled Jason to maintain his long-term Bitcoin exposure while actively managing short-term volatility. Instead of being forced to make binary decisions to hold or to sell or to hold or to sell or to be long or short, the micro futures gave him flexibility to partially protect his position and strategically add to it during market weakness. And I think that you can make a case now, if Jason were thinking about this from the perspective of the current trend, what are we doing now? We're trailing extensions, right? No need for a hedge yet. No trend break. What if the extensions were to fail? Then he'd need to go look at what the hedge was in the very first measured move short after a trend break as well too. Where do the hedges come off? Extension failures, trend breaks. Where do hedges go on? When the trend breaks. Now, these strategies, okay, they're not exclusively for measured moves. You could use any strategy with hedging. But I do believe, and maybe I'm a little bit biased, that measured moves do complement the process of hedging much better than other strategies. Let's do another example here, since it's so timely right now. Gold. We're sitting up at highs here. Let's actually think about gold from 2002. That was the last big decline here. That was when the Federal Reserve was going into rate hikes, right? And what happens when the Federal Reserve is hiking interest rates? The dollar increases. When the dollar increases, what does gold typically do? It goes down. Let's call this gentleman Daniel. Daniel is a retired financial professional with a substantial gold allocation. He had accumulated 650 shares of the Spider Gold Trust GLD over several years as an inflation hedge in a portfolio diversifier. By March of 2022, it's up here, as we are running back up into these previous highs up here, which, by the way, was an extension failure. There was an extension failure up here. We failed to make new highs. So just in measured move terms. In March of 2022, his GLD position was worth approximately $120,250. GLD was trading around $185 a share. So let's plug that in to the hedging calculator here. First, we're going to change it. What mirrors GLD? Gold. You could also use micro gold if you had a smaller position. What was gold trading? Gold was trading around 2000 or 1950. His position was 120,250. Looks like it's 6 contracts. In early 2022, with inflation readings at multi-decade highs, Daniel recognized the Federal Reserve would likely aggressively raise interest rates. He understood that rising real interest rates typically create headwinds for gold prices. Rather than abandoning his strategic gold allocation, he implemented a futures hedging strategy. He sold 6 micro gold futures contracts, which represents 10 troy ounces of gold each contract. This created a hedge covering over 100% of his GLD exposure. As the Fed began to aggressively hike interest rates between March and September of 2022, let's go back to the gold chart here. March and September of 2022, GLD declined from $185 to $150, a 19% drop. Daniel's GLD position decreased from $120,000 to $97,000, a paper loss of over $20,000. However, his short micro gold futures positions gained approximately $25,000 in value. In November of 2022, with gold near its lows, again dipping into its lows, inside of this gigantic pullback. This was the last big one. Daniel believed that the market was largely pricing in the Federal Reserve's hawkish stance. He closed 4 of his 6 micro gold futures contracts, realizing $16,700 in profits. He maintained 2 contracts as a continued partial protection. Using the $16,700 in realized hedge profits, he purchased an additional 110 GLD shares at approximately $150 per share. The psychological benefits during the rate hiking cycle, the futures hedge provided critical psychological advantages. Many gold investors abandoned their positions entirely during the Fed's tightening cycle. Daniel's hedge allowed him to maintain his strategic allocation while managing tactical risk. The realized profits from the hedge made it psychologically easier to add to his position when gold sentiment was negative. The remaining partial hedge provided ongoing comfort as the Fed continued raising rates. As the rate hiking cycle matured in early 2023, markets began anticipating the end of the Federal Reserve's tightening cycle. GLD gold began recovering, rising back above $160 a share in February of 2023. Daniel's enhanced position, 688 shares versus the original 650, captured more of the recovery. So he used, not only had a loss, offset the loss, but he added shares inside of the pullback. He eventually closed his remaining gold micro futures contracts when inflation began moderating. By maintaining his gold allocation rather than abandoning it, he remained in a position for gold's eventual recovery. This example demonstrates how futures hedging can be particularly valuable during monetary policy shifts. The psychological resilience provided by the hedge enabled Daniel to maintain his strategic gold allocation despite temporary headwinds. Rather than making a binary decision to hold or to sell his entire position, the futures contracts gave him flexibility to manage risk while capitalizing on lower prices. This approach allowed him to improve his long-term position in gold while minimizing the emotional and financial impact of the Fed's aggressive rate tightening policy. We had a little trend break up here this week. We hit 3,500. We broke an extension. And in the very first measured move short after a trend break, and this was last night during Asia, you saw a very large group of individuals, and this is in measured move terms, appeared to be hedging at the 38.2% line. This is an example of protecting a position and looking to capitalize on the pullback, to not lose, not draw down, and to use a futures contract to fund adding to your position. So to wrap up, the psychological benefits of hedging. Hedging provides several important psychological benefits that can significantly improve your investing experience and decision making. Reduced anxiety and emotional stress. When you are appropriately hedged, market volatility becomes less emotionally taxing. You can sleep better at night knowing you have protection against severe drawdowns, which reduces the constant worry that often accompanies the unhedged position. It prevents panic selling. One of the most valuable psychological benefits is how hedging helps prevent costly emotional decisions. When markets decline sharply, unhedged investors often panic sell at the worst possible times. With hedges, you're less likely to abandon an investment strategy during market turbulence. Hedges create a mental security needed to stay invested during market corrections, to continue to dollar cost average during drawdowns, and to add to positions when others are fearful. This confidence often leads to better long-term results, as you can execute your investment plan with discipline rather than reacting emotionally. It helps in clear decision making. When protection is in place, you can evaluate market movements more objectively. Your judgment becomes less clouded by fear and greed because the immediate threat to your portfolio is reduced. This clarity often leads to more rational adjustments to your positions. Many investors obsessively check their account values during volatile periods. Hedging can reduce this behavior by dampening portfolio swings, leading to less fixation on short-term fluctuations and more focus on long-term goals. Knowing you have downside protection encourages more thoughtful position building. The one thing that I want to stress about this, and I want you to think for a moment and put yourself in the mind of the collector, because that's what most of the market or how it is positioned. And when you think about the market from the perspective of a collector, when there's a trend break and a next measured move, it's not somebody that's bearish. They're just protective. And when you put yourself in that perspective, it's very easy to understand how a trend can continue. In this most recent gold pullback that we're inside of here, theoretically down into the 31.55s. Will hedgers keep selling 50% shorts along the way? Hedging and taking profit, and hedging and taking profit, and hedging and taking profit. Measured moves included in this are a potential machine to accumulate more shares. There's another benefit that we haven't touched on that much either, is the path that it's much easier to go along with the path of least resistance than it is to fight a trend. And there's no better an example than gold. You know, you think about this last couple of years, and when you think about all of the pullbacks, if you're just a trader and you're trying to catch the bottom of a move and you're thinking about it from the longer term perspective, it's almost impossible. Because a lot of the move of an instrument happens in 10% of the time. It's often said that 10% or 90% of the gains happen in 10% of the time in the stock market. That's true for almost any instrument. So to have a position that you're working inside of, knowing the longer term time frame, it allows you to trade it and be an investor. There's another kind of adaptation as well too to an investing or a strategy where you take a little bit longer term view, is where you split up a position. And we'll just make an example for with micro E-mini S&Ps. So let's just say that, let's do another what if scenario here really quickly. Just put 53. Where are we? We're at 5,400, aren't we? 54. at 5,400, and let's just say that you were going to trade. You had a $25,000 account. So you could trade one contract, right? But that one contract also, could you buy $25,000 of the SPY? Certainly. But what if you split the position in half? What if you bought $12,000 worth of SPY? Or, $18,000 or $19,000 or $22,000 worth of the SPY ETF? How much does it cost for margin? Typically, a broker likes to see right around 75%. If you rise above 80, they'll make margin unavailable. So these are kind of some of the little idiosyncrasies here, but having splitting a position between the ETF and the futures allows you to do a couple things. One, you can be just in a SPY position and be traveling along the path of least resistance and having reserves, enough to cover margin to add a ES futures contract to accentuate a bullish trend, right? You could be flat the futures contract and just be long SPY. You could be long the SPY and short the ES futures contract, and it's now hedged. And it gives you the best of both worlds. If you've ever been in a situation where there's this whole concept of when you are out of a trade that you have rightfully taken profit on, you wish you were back in, right? If you've ever, hit a profit target and you've taken profit at the target and, it just keeps on going. This is a great example of the psychological benefits as well, too, of being involved in the move. There's also, this market that we've been inside of here just recently, where the entries are, to someone that's just statically long and just collects S&P or SPY ETF positions, and they don't care. They look forward to these downturns. Why would they look forward to the downturn? Because they're collecting shares. They're protecting themselves from downside risk and adding to position. A 50% drawdown isn't something to be scared of at that point, is it? A 50% drawdown means you've accumulated 50% more shares. 50% more shares. So this is a very big topic, and I'm gonna cut this off at an hour here. I'm just gonna leave this open, to questions inside of the chat. But I hope this webinar will make you start to think about different ways. It's not just all in, all out. If you have any questions or comments, send me an email at eminiaddict@gmail.com, and I will be certain to answer your questions. All right, guys, have a great afternoon.